Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
All right, everyone, welcome back to the Deep Dive, where we take these deep dives, into all sorts of fascinating business topics.
Absolutely.
And today, we're going to be tackling mergers and acquisitions, but with a specific lens, and that's this idea of compounding quality.
Okay.
So we'll be using, as our guide, a practical guide to mergers, acquisitions, and divestitures.
Interesting.
So let's jump right in. What is compounding quality, especially as it relates to mergers and acquisitions?
Well, think of it this way. Instead of making one big, risky acquisition, you focus on a series of smaller, high-quality businesses that can grow together over time.
Okay, so it's more about building a portfolio of companies rather than betting it all on one mega merger.
Exactly. And what's really interesting is that this strategy is particularly well-suited for the lower middle market.
Lower middle market. Now, why is that?
Well, for a couple of reasons. Smaller businesses often have more room to grow, and they can be acquired at lower premiums than their larger counterparts.
Okay, so less initial investment for potentially greater returns. Got it.
Right. And then there's this huge opportunity for what we call cost synergies.
Cost synergies. Now, is that just a fancy way of saying saving money?
It is about saving money, but it's a bit more nuanced than that. It's about recognizing that smaller businesses might be operating less efficiently on their own.
Okay.
So by combining them, you can streamline processes, eliminate redundancies, and really boost profitability.
I see.
Our source material points out that back in 2006, there was a record number of M&A deals driven by companies in the same industry merging to, gain an edge.
Makes sense, yeah.
And capitalize on those cost synergies.
So it's like everyone was trying to gobble each other up?
You could say that, yeah, and many of these deals involved lower acquisition premiums, so companies were really getting more bang for their buck.
So we're seeing how the lower middle market can be a great place for this compounding quality strategy.
Right.
But, like with any investment, there are always risks. Right?
Absolutely.
It can't all be sunshine and roses.
You're right. And our source actually throws out a pretty sobering statistic. Only 23% of acquisitions earn their cost of capital.
Oh, wow. So the vast majority of M&A deals don't actually make money.
That's right. So clearly, compounding quality isn't a magic formula for success.
Okay, so how do we avoid becoming another statistic? What separates the winners from the losers in the M&A game?
Well, that's where things get really interesting. Our source highlights a number of potential pitfalls to watch out for, and it all comes down to making smart decisions every step of the way.
Okay, like what?
Well, let's start with something called reverse synergies, essentially the idea that a poorly executed merger can actually destroy value instead of creating it.
Wait, so instead of 1 + 1 = 2, we end up with 1 + 1 = something less than 2.
Exactly, yeah.
How does that even happen?
Well, it often happens when integration is botched, leading to clashes in company culture, loss of key personnel, or disruptions in operations.
So integration is like a make-or-break moment.
Absolutely. And speaking of things that can break a deal, another trap is overpaying for growth.
Oh, I see.
It's tempting to go after those companies with sky-high growth rates, but often those impressive numbers come with inflated prices.
Yeah, and might not be sustainable.
Exactly. Our source cautions against chasing those shiny objects without carefully considering the underlying factors driving that growth.
So it's not just about how fast a company is growing, but the quality of that growth.
Precisely.
Okay.
And then there's always the potential for antitrust action to throw a wrench in the works.
Antitrust action. Now that sounds serious.
It can be. If a merger is deemed to create too much market concentration, it could raise red flags with regulators, leading to delays, legal challenges, even block deals.
Okay.
Yeah.
So due diligence isn't just about the financials. It's also about understanding the regulatory landscape and potential legal hurdles.
Exactly.
All right. I'm already feeling like I need to take a deep breath here. Clearly, there's a lot to consider when it comes to compounding quality through acquisitions. But I'm also really intrigued by the potential here, especially in this lower middle market.
It definitely is an area ripe with possibilities for those who are willing to do their homework and approach it strategically.
Absolutely. And I think that's a great point to maybe take a little pause and we'll come back and talk about some more of the specifics.
Sounds good.
Okay.
All right.
Okay. So we've talked about some of the potential, downsides and things to watch out for,
Right.
like reverse synergies and, overpaying for growth and antitrust action.
Uh-huh.
But let's kind of flip the script here a little bit and talk about, some real world companies that have actually successfully used this compounding quality approach,
Sure.
particularly in the lower middle market.
Yeah, well, there are countless examples, both, large and small companies that have really built these, empires
Yeah.
through strategic acquisitions. But one that comes to mind, particularly in the lower middle market, is Constellation Brands.
Constellation Brands, the beer, wine, and spirits company.
That's right. Yeah.
Okay.
They didn't start out as a beverage giant. They strategically acquired smaller, high-quality brands over time, everything from craft breweries to premium winemakers, and integrated them into their portfolio and really created a powerhouse in that industry.
That's a great example. Yeah, I'm starting to see how this can play out over time.
Yeah.
But I'm curious, our source material mentions this incredibly detailed checklist for due diligence.
Yes.
It seems like a lot to cover, even for someone with, experience in M&A.
It is. It's comprehensive for a reason. Thorough due diligence is absolutely essential for any acquisition.
Right.
But it's especially critical when you're aiming to compound quality over time.
Okay, so let's say I'm a business owner and, I'm considering an acquisition. What are some of the non-financial factors that I should be paying attention to during due diligence?
Yeah, that's a great question.
We've talked about the numbers, but what about the human side of things?
Yeah, you're hitting on a crucial point. Our source material really emphasizes the importance of looking beyond just the balance sheet. One key factor is management quality.
Okay.
You need to assess the leadership of any business you're considering acquiring. Are they experienced? Do they have a proven track record? Are they the right people to lead the company through a period of growth and change?
So it's about making sure that the people in charge are capable of, steering the ship in the right direction.
Exactly.
Got it.
And then there's cultural fit,
Okay.
which can be a major stumbling block if it's not addressed. If the company cultures clash, it can create friction, resistance to change, and ultimately hinder growth.
I imagine that's especially important when you're talking about integrating smaller businesses that might have very, distinct cultures.
Absolutely. And finally, you need to ensure strategic alignment. Before you even consider an acquisition, you should ask yourself, does this business fit into our overall strategy?
Okay.
Does it help us achieve our long-term goals? It's not just about finding a good business. It's about finding the right business.
At the right time.
At the right time for your specific goals.
So it's like fit pieces into a puzzle. They need to connect in a way that makes sense for the bigger picture.
Precisely.
Okay. I like that analogy.
And that leads us to another crucial aspect of compounding quality, and that's the integration phase.
Okay.
What happens after the deal is signed, because a smooth integration is absolutely essential for achieving those long-term goals and realizing the full value of the acquisition.
And our source material actually dedicates a significant chunk to this integration process.
It does.
It really stresses that it's not just about merging balance sheets and operations. It's about bringing together people, cultures, and systems in a way that creates this, cohesive and high-performing whole.
Yeah, and it highlights that there's no one-size-fits-all approach. Each integration really needs to be tailored to the specific companies that are involved.
So where do you even begin? I mean, it can feel kind of overwhelming.
Well, our guide recommends taking a phased approach.
Okay.
And it all starts with a detailed integration plan. This plan outlines the objectives, timelines, and responsibilities for each stage of the process.
So it's like creating a roadmap
Exactly.
for how the two companies are going to come together.
Exactly. But it's not just about the technical aspects. Perhaps the most important element of the integration plan is addressing the people side of the equation.
The human element.
Absolutely, because even the most logical and well-planned integration can be derailed if you don't consider the impact on employees.
And our source material really drives this point home. It talks about the importance of clear communication, transparency, and empathy throughout the entire process.
Yeah, people need to understand what's happening, why it's happening, and how it will affect them.
Right, because if they don't get that information, they're just going to, fill in the blanks themselves.
Exactly, and that can be really damaging.
Yeah.
So it's about getting ahead of the rumor mill and providing reassurance. It's about transparency and empathy. It's about acknowledging that this is a big change and providing support to help employees navigate it.
So you're saying we should almost treat employees like internal stakeholders in the merger.
That's a great way to put it.
Okay.
Along with clear communication, it's also essential to establish a shared vision for the combined company.
Right, because if everyone's rowing in different directions, you're not going to get very far.
Exactly, and this is where our guide's emphasis on cultural integration really comes into play.
Okay.
When you merge two companies, you're often merging two very different ways of doing things.
Right.
And if those cultures clash, it can create a lot of friction.
I've heard stories about, mergers gone wrong because of those cultural clashes.
Yeah.
It's like mixing oil and water.
Exactly. It's a real risk, and that's why our source material recommends taking a proactive approach to cultural integration.
Like what kinds of things?
Well, think about things like creating opportunities for employees from both companies to interact and learn from each other,
Okay.
developing shared values and norms, and even celebrating the unique strengths and contributions of each culture.
So it's about finding ways to kind of bridge those differences and build a new cohesive culture.
You got it. And remember, this whole integration process takes time. It's not something that happens overnight. Patience, persistence, and a willingness to adapt as you go are essential.
I bet.
We'll delve a little bit deeper into the nuances of integration in the final part of our deep dive.
Okay, sounds good. Okay, so we've talked about why the lower middle market's good for this strategy and, some of the pitfalls to watch out for.
Right.
And we've also talked about some of those important non-financial factors to consider. But let's zoom in on this integration phase. It's not just about merging spreadsheets, is it?
No, not at all. The integration phase is where the rubber meets the road. It's where all of that careful planning and due diligence either pays off or it falls apart. And our source material really stresses that there's no one-size-fits-all approach.
So every merger is unique.
Pretty much, yeah. Each integration really needs to be tailored to the companies involved.
Okay, so where do we begin? What's step one in putting together a successful integration plan?
Well, our guide recommends focusing on communication right out of the gate.
Okay.
And not just, sending out a company-wide email announcing a merger. It's about really proactively addressing the concerns and anxieties that employees are going to have during this, time of transition.
Because change can be scary when it's for the better.
Exactly. People want to know, how is this going to impact my job? How is this going to impact my team, my day-to-day work? And if they don't get clear and consistent communication, they're just going to fill in the gaps themselves.
With rumors, with gossip.
Exactly, which can be really damaging to morale and productivity.
So it's about getting ahead of the rumor mill.
Exactly. It's about transparency. It's about empathy. It's about acknowledging that this is a big change and, providing support to help employees navigate this.
So almost like treating employees as, internal stakeholders.
Yeah, that's a great way to put it. And along with that clear communication, it's also essential to establish a shared vision for the combined company.
Okay, make sure everyone's on the same page.
Exactly. And this is where our guide's emphasis on cultural integration comes in.
Right.
When you merge two companies, you're often merging two different ways of doing things.
Right.
And if those cultures clash, it can create a lot of friction.
Yeah, I've heard horror stories about this. Cultural clashes can really sink a merger.
Absolutely, and that's why our source material recommends taking a very proactive approach to cultural integration.
Okay, so what does that look like?
Think about creating opportunities for employees from both companies to interact with each other.
Okay, get to know each other?
Yeah, develop shared values, shared norms,
Okay.
and even celebrate the unique strengths and contributions of each culture.
So find that middle ground where they complement each other.
You got it. And remember, this whole immigration process takes time. This isn't something that happens overnight. It's about patience, persistence, and a willingness to adapt along the way.
And I imagine having a strong leadership team that can kind of steer the ship through all of this is really important.
Absolutely. Couldn't agree more.
Well, we've covered a lot of ground in this deep dive into compounding quality.
We have.
Any final thoughts for our listeners before we wrap things up?
Yeah, I would just say that the lower middle market really does offer fertile ground for those who are looking to build value through strategic acquisitions. The key is to approach it with a long-term perspective, a commitment to doing your homework, and, really understanding the nuances of integration.
Yeah.
It's not a get-rich-quick scheme. It's a strategic and disciplined approach to building something really special over time.
And on that note, a huge thank you to you for sharing your expertise, and to all our listeners out there, keep exploring, keep learning, and we'll see you on our next deep dive.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace, or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.